Caitlin Long, founder of Custodia Bank and a prominent voice in the Bitcoin community, casts scathing doubt on Ripple's model. It's calling attention to pre-mined supply, token distribution, and what she describes as network centralization. And almost immediately, the crypto world lights up with controversy as XRP, seemingly impervious to the critique, rockets some 70% in July and puts a very public question on the table. Can XRP shut down its critics and sprint to $7? Let's unpack this like traders and institutional allocators would, looking at facts, incentives, and plausible scenarios on both sides, because beneath the drama are concrete mechanics that decide whether a $7 target is plausible or fanciful. First, take Caitlin Long's critique seriously insofar as it highlights real structural differences between XRP and chains like Bitcoin or Ethereum. XRP was indeed pre-issued at launch, and Ripple has historically held and distributed large tranches. And that token distribution plus early institutional relationships has long been the source of the centralization debate. From a conservative institutional vantage point, pensions, treasuries, or sovereign asset managers, those token issuance questions matter because they shape counterparty risk and governance optics. If a sovereign treasury were to tokenize assets, or a bank were to cede custody with a blockchain asset, confidence in the network's decentralization and issuance policy is a gating item. Critics argue Ripple's model creates an overhang of concentrated supply and governance dependence that can spook large, conservative allocators. Those are valid concerns, and they feed into risk premiums that professional allocators price into XRP versus something like Bitcoin or a permission token with clear regulatory guardrails. Yet the counterargument is equally powerful and grounded. Decentralization is not binary, and network utility, validator distribution, and demonstrable on-chain usage matter a great deal. Ripple and defenders point to a broad set of independent validators, real-world payment partnerships, and technical throughput as evidence that the ledger can function in a decentralized way for cross-border payments. In markets, price discounts caused by perceived centralization can and do compress when either legal clarity arrives or when real economic demand outstrips supply to dynamics that, together, explain why XRP could surge even under vocal criticism. Now, look at what actually propelled the 70% move, and could plausibly drive the next leg toward multi-dollar targets. There are several distinct measurable factors investors should watch. First, the evacuation of supply from exchanges data showing hundreds of millions of XRP. Leaving major custodial books reduces the immediate available float and therefore the marginal selling pressure. That purely mechanical change in supply dynamics can support higher prices if buying interest persists. Second, institutional flows and narrative catalysts matter enormously. Signals that firms like SBI or large treasury buyers are compiling allocations, or that ETF structures are being considered serve as demand accelerants, attracting both long-term strategic money and momentum traders chasing price discovery. Third, legal outcomes particularly. A favorable conclusion to the SEC's litigation posture, a Brzezinta regime change, a court decision or settlement that clarifies XRP's status in major markets would remove regulatory overhang and open the door to US institutional adoption at scale. Those are the ingredients that transformed the narrative and drove July's rally, and could, under the right sequence, drive a move toward higher targets. But none of these levers is a given, and each carries binary outcomes. Exchange outflows could reflect accumulation or prepared distribution. Institutional interest can be tentative, exploratory, and subject to internal approvals. Legal rulings can go either way or create long transition periods. The most crucial single data point is therefore the legal trajectory. If regulators effectively lift a ban or confirm non-security status, the implied pool of addressable capital balloons. If not, adoption stalls and speculative inflows can reverse quickly. The on-chain signal called out in the video. NVT spike illustrates the ambivalence that investors must wrestle with. A rising NVT ratio indicates that market value is increasing faster than on-chain transaction value. which can be a classic sign of speculative appreciation rather than fundamental utility growth. In other words, price is outrunning the underlying network usage, suggesting short-term traders might be driving the move more than increased payments or settlement volume. That's a risk flag, because speculative rallies without proportionate growth in real usage can be fragile. Momentum can be reversed by a shift in leverage or sentiment. Yet the same NVT increase can be interpreted as a lead indicator that institutions are accumulating for strategic purposes, buying now in illiquid markets before executing larger projects that will later increase on-chain throughput. Interpretation depends on context and subsequent data. If NVT rises, and then transaction volumes and TVL total value locked, counterparties, or payment flows also increase. The spike becomes less worrisome and more like a front-running of fundamental adoption. Another practical observation: whales and treasury allocations can create powerful feedback loops. Large withdrawals from exchanges reduce supply and signal intent to hold. Big buys by credible entities provide social proof, attracting retail and algorithmic interest that amplifies price movement, but the mirror image is also true. Concentration of holdings gives large players the ability to distribute into rallies, turning bullish accumulation into a sell-the-news event. That's why liquidity metrics order book depth around critical price bands, derivatives open interest, and the distribution of long versus short positions are essential to monitor in real time. A thin order book near multi-dollar levels means a relatively small amount of capital can whip the market. That's great for leveraged gains, but terrible for durability. Let's parse the $7 thesis specifically. For XRP to reach a number like $7, three things generally need to be true in sequence: meaningful reduction of readily sellable float-through withdrawals, staking treasury lockups, demonstrable and sustained increases in real usage or institutional demand on chain volume, custody mandates, ETF inflows, corporate treasuries, and a permissive macro regulatory backdrop that channels global liquidity into risk assets. If those align, supply tightens, demand institutionalizes, and liquidity is ample, then price discovery toward multi-dollar levels is plausible. The upside path is not linear. It typically unfolds in stages, with short squeezes and narrative pushes creating interim breakouts that test sentiment. That's the playbook markets have followed across asset classes. But the downside path is equally plausible if regulatory clarity slips, if large holders decide to rebalance into fiat, or if macro tightening drains liquidity. The price could retest previous support levels, and the $7 scenario would likely be delayed or derailed. From a risk management standpoint, participants should avoid binary thinking. For traders, scaling into positions, using staggered entries, and maintaining stop losses tied to liquidity bands can protect capital against sudden reversals, especially in an asset that can be influenced by rapid sentiment shifts. For institutional allocators considering strategic positions, conditional exposure placing capital contingent on legal or custodial milestones reduces tail risk. And for anyone holding XRP, diversification and position sizing according to one's time horizon and risk tolerance remain fundamental. We also have to acknowledge reputational and structural risks that critics like Caitlin Long raise. Governance practices transparency in token distribution, and validator decentralization are not just academic critiques, they shape institutional willingness to adopt remedies that Ripple or the broader XRP community could pursue greater transparency about holdings. Gradual, verifiable lockups or burns, empowering independent validators, and publishing governance roadmaps would materially reduce adoption friction. Conversely, if excuses or opacity persists, even spectacular rallies can turn into short-term theater without durable adoption. Finally, timing and narrative interplay matters as much as fundamentals. Crypto markets often overreact to headlines, and narratives can outpace fundamentals for weeks or months. A favorable legal outcome combined with an institutional product launch would likely catalyze rapid repricing. Conversely, a legal setback or a high-profile security incident could produce a violent repricing downwards. The prudent lens is probabilistic rather than absolutist. The $7 target is within the realm of possibility given the right confluence of legal clarity, institutional demand, and supply dynamics. But it is not a foregone conclusion and is counterbalanced by clear, credible downside risks rooted in distribution, regulatory uncertainty, and speculative fragility.